Most founders think angel investors invest in ideas. Angel investors know they invest in risk-adjusted asymmetric upside, and that misunderstanding costs startups millions. Founders polish pitch decks, they memorize TAM slides, they obsess over valuation. But angels are asking completely different questions. Can this founder execute under uncertainty? Is this market mispriced? Is this opportunity early, but not too early? Does this founder understand risk better than I do? When founders misunderstand what angels truly evaluate, three things happen. Funding conversations stall, valuations collapse, credibility erodes. Today we break down what angel investors really look for from both the investor and founder perspective. No fluff, no hype, just strategic clarity. An angel investor is typically a high net worth individual, investing personal capital at early stages pre-seed seed in exchange for equity. But that definition is too shallow. Angel investing exists because early stage risk is too high for traditional capital. Banks need collateral, VCs need traction, private equity needs cash flow. Angels fund uncertainty. They operate in the gap between idea validation, prototype, product market fit, founder vision, market evidence, where angels fit in the life cycle. Pre-revenue or early revenue, MVP stage, early traction experiments, market testing phase. Who cares about angel capital? Founders, first institutional signal. VCs, angels validate early risk. Boards, cap table structure, future investors, signaling effect. Angels aren't just capital, they're risk translators. Financial implications. The right angel investor can increase valuation credibility, accelerate funding rounds, improve follow-on capital access. The wrong angel pollutes cap table, creates governance friction, slows institutional entry. Strategic implications. Angels often influence early hiring, strategic pivots, market positioning, go-to-market sequencing, risk exposure. If you ignore what angels actually evaluate, you optimize pitch aesthetics instead of business fundamentals. You overestimate TAM instead of proving traction mechanics. You chase valuation instead of de-risking. Long-term impact. Angels are often on your cap table for 7-10 years. That decision compounds. Master this. You gain leverage. Ignore this. You surrender it. Let's shift perspective. When angels evaluate a startup, they look at 1. Founder, quality, execution track record, pattern recognition, coachability, psychological resilience, bias toward action. They ask, will this founder survive uncertainty? 2. Market timing. Not just is it big, but is it emerging? Is adoption accelerating? Is regulation enabling or blocking? Is behavior shifting? They invest in inflection points. 3. Risk concentration. They evaluate customer concentration risk, technical dependency risk, regulatory exposure, competitive defensibility, burn rate velocity. Angels aren't allergic to risk, they're allergic to blind risk. 4. Traction signals. Early traction doesn't need to be revenue. It can be retention curves, wait lists, usage depth, referral velocity, paid pilot commitments. They're measuring signal strength, not vanity metrics. Red flag spotlight. Founder can't explain CAC clearly. No clear problem ownership, overconfidence without data, cap table already messy. We have no competition. Silent deal breakers. Myth 1. If the idea is strong, funding follows. Reality, execution clarity beats conceptual brilliance. Myth 2. Angels just want equity upside. Reality, they want asymmetric upside with credible downside protection. Myth 3. Pitch harder. Reality, structure smarter. Execution gaps. No risk mapping, no scenario modeling, no unit economics clarity, no milestone-based capital plan, no governance foresight. This isn't about blaming founders. It's about elevating strategic thinking. Here's the MP Nerds evaluation framework. Step 1. Idea validation. Is the problem acute? Is the buyer identifiable? Is the willingness to pay measurable? Step 2. Feasibility analysis. Technical feasibility, operational feasibility, regulatory feasibility, financial runway mapping. Step 3. Risk map. Map. Market risk, execution risk, financial risk, dependency risk, governance risk, quantify where possible. Step 4. Strategic roadmap. Define 6-month milestones, 12-month capital checkpoints, de-risking sequence, hiring triggers. Angels invest in clarity of trajectory. Step 5. Positioning strategy. Instead of "we're a marketplace," say "we are solving X inefficiency with Y mechanism, reducing Z friction by 42%. Precision builds confidence. Startup A, beautiful pitch deck, inflated TAM, no retention data, no milestone plan, no risk mapping. Result, 3 meetings, no term sheet, feedback, too early. Startup B, clear problem ownership, cohort retention data, structured capital plan, identified risk plus mitigation, clear hiring roadmap. Result, angel syndicate forms, round closes in 6 weeks, valuation premium of 20%. The difference wasn't the idea, it was investor readiness. Second-order thinking. Angels don't just evaluate your business, they evaluate follow-on investor psychology, exit attractiveness, governance structure maturity, signaling effect, hidden risk, too many angels, unstructured rights, no voting alignment. Exit implications. If angels feel misaligned, they block exits. Elite founders design cap tables strategically, not emotionally. Angel investing is not about belief, it's about calculated conviction. What it is, early-stage risk capital with strategic influence. Why it matters, it shapes valuation, trajectory, and future capital access. Where founders go wrong, over-optimizing storytelling, under-optimizing structure. What professionals do differently, they de-risk before they raise. At MP Nerds, we don't just build MVPs. We structure businesses to be investor-ready through idea validation and feasibility analysis, structured risk assessment, strategic road mapping, market positioning, governance foresight. We help founders move from interesting idea to investable opportunity. If you're building something ambitious, drop a comment. What stage are you at? Idea, MVP, traction, or raising? And let us know what topic we should break down next. Subscribe for strategic startup intelligence, not hype. Professional, structured, investable. MP Nerds.